This week, I went ahead and purchased another couple $1,000s worth of Taiwan semiconductors. My total share count sits at 224 at an average cost of $76.81. Though I'm up a few $1,000s, I'm going to put a pause on purchasing more shares until the stock cools off a little bit because I think this rally is getting a little too aggressive. I've been announcing all my share purchases now on my Patreon account, where we've also been doing really in-depth personal finance around my life stuff I will not talk about on this YouTube channel. And I want to shout out Jason, Andrew, the newest supporters. If you guys want to support, the link is down in the bio. It's less than a Starbucks coffee a month, and I think I'm offering 10x the value than that coffee ever would. My portfolio value today sits about $415,000. It's been very nice as the market's been rallying into the beginning of this year, but again, I hope it cools off because I figure this is the year we'll become millionaires, because you get rich in these recessionary environments, continuing to cost average into really good foundational investments. And speaking of that, I want to talk on stocks that Jeremy's buying from Financial Education. As you may recall, a month ago, he revealed his addiction to over leveraging into highly speculative investments that wrecked his portfolio upwards of losing $1 million+. And now he's been getting really aggressively back into the market. And the stocks he's deciding to purchase, I think, are still incredibly risky. He's just picking the most speculative large caps. And I want to talk about how I feel about some of these companies in his video here, as he says 7 stocks I'm buying now in January of 2023, with the first one being Tesla, that recently announced that they're going to be cutting prices of their vehicles, which could hurt margins. But the fact is we're seeing commodities come down in price. Logistics are probably sorting themselves out, allowing them to lower prices, and heading into a recession, this could also bump demand. So it'll be neat to see as earnings go forward what actually happens with the bottom line and their margins, because now you can buy a Model 3 for about $44,000. There was a recent tax credit that was announced in 2023 that you can get back of $7,500, bringing this down to the mid $35,000 range, which is pretty incredible, right? But that's excluding if you want to get full self-driving, which is still $15,000. And again, full self-driving, just remember that it's a little convoluted that we state that, even though it's not what it is. And Jeremy runs some valuation metrics, and this is where things really bother me, because these companies, in my opinion, are still so overvalued today that all you can do is speculate on future growth, which again is speculating. And we're going to talk about some of that, as we can see that he's expecting revenue to be around $330 billion by 2027, with net income of about $51 billion. And then he runs market cap valuations from a 10 PE to a 50 PE. And talking about the price to earnings metric here, if this company had full self-driving generating income, if it had robotics generating income, if it had AI software that was generating income, I could easily justify a 30 to a 40 PE. But the fact of the matter is, in this moment, it doesn't have any of that, and it generates all its income off auto sales, which is very scary for me personally, making it really hard to wrap my head around what's going on. And it makes me want to sideline the company until they prove some more of their business model out heading into this recessionary environment. And let's be real, recessions hit auto companies the hardest. Now, Jeremy likes to focus on net income and stuff that I don't think matters as much as free cash flow. And Tesla's had a really incredible free cash flow growth, but that's where we get the price to earnings multiple. Do I really want to pay a PE of 40 in the moment for the current cash flow? And the quick answer to that at a glance is absolutely no for me. Now, if I was in my 20s, I'd be more inclined to take speculative risk, but being in my 30s and having the scale of the portfolio I have, I feel there's better investment decisions outside of Tesla in this moment, but that could change over the next year, and I'll always keep an eye on Tesla and let you guys know when I decide to purchase it back. Leading into the second stock here that I find interesting being Shopify. Once was the largest company in Canada, is currently now trading for $67 billion, and it's hard again to justify the value of this company. Now, Shopify's got a really incredible moat. It's a wonderful business that is growing really dramatically, but again, the free cash flow, you can't justify any value on it because they're investing aggressively into warehousing, trying to do what Amazon's doing. When you look at the income statement and you look at the revenue growth, it's all wonderful, but at the current valuation, it's priced in years and years of value. So you're really trying to sit on your hands for the next 3 to 5 years and let that value bake in, which again, to me, is more inclined toward a younger investor who can afford waiting a decade to get that growth, but not for an experienced investor sitting on millions of dollars, or even someone in my position. It makes it very hard to buy when you can't put your finger on the exact value of this current moment. And we start seeing this similar trend with all of his stocks, including Amazon, because I can't figure out why he's choosing the most highly valued companies on the S&P when you could slightly overpay for companies like Microsoft that has an incredible subscription service, incredible stabilized revenue, or even Apple for that matter, which it'll be neat to see how Apple survived the Christmas holiday coming into this earnings season, which all these companies are going to be posting earnings soon. But look at Amazon. Even though Amazon's down 47% off its highs, how do you justify a company that's never taken revenue from their primary income source being e-commerce? They have only made money off basically cloud services, and we can see since we've kind of headed into this recessionary environment, They've done tons of job cuts. Everything is slowing down for them. I just can't foresee why you would think this would be the most prudent investment out of many other companies. Now, I do like Amazon. My fiance owns Amazon. I got nothing against it. It's just not a place I would be putting huge amounts of capital because, again, free cash flow growth has been non-existent for the last couple of years, and you can only justify the value of a company as a shareholder getting free cash flow return and then either getting a dividend from that or them reinvesting that value and actually, retaining that capital and giving you really good growth into the future. Again, it's very, very hard with what's going on in the current environment to tell if this is a buying opportunity or if these stocks are going to drop dramatically more into the future, which leads me into this really stupid decision that I think he's doing that makes absolutely obliterately no sense to me. And I want you to take a listen just for a minute.
I have to hedge a little bit. And there's a reason high net worth individuals all hedge. There's a reason hedge funds are so popular, right? And so the way I kind of look at this is it's just a simple hedge to my portfolio. Small position, but guess what? The Dow goes down 10, 20, 30%. My call options in SDAO are going to print ridiculous amounts of money, as well as if I own any SDAO straight up, okay? And so to give you an example of kind of how this works, right? I'll just show you what happened today. Today, the Dow Jones Industrial Average went down 1.1%. SDAO went up 3.4% today, right? So if there's a scenario where the Dow goes down 10%, then SDAO should be up 30%, right? And so that's all this is. It's a hedge. I'm not trying to make bank on this. It's just if the market tanks, I'm going to save face and I'm going to be in a situation where I'm going to be able to capitalize on the market going down, go ahead and flip out of SDAO and put that into long positions if it happens. And something I do know is most of those Dow stocks are very, very overvalued right now.
Now, take this for what it's worth. It's just my personal opinion, but I cannot wrap my head around why he would make this investment decision. Now, as coming from a guy that's never shorted a company, who has outperformed Warren Buffett, even the likes of Jeremy here by leaps and bounds, by hundreds of percent over the last 7 years, the whole point of hedging your portfolio is to do just that, hedge your bets. And the bets you're making are of the most volatile and most speculative that pretty much sit on the S&P 500. Like, I could justify buying Google or Meta here, but you're literally buying the most volatile companies, and you're going to protect your portfolio by betting against a broad-based index, basically, the Dow 30, which doesn't even closely relate to your stocks. You're better off shorting the NASDAQ if you wanted a hedged bet that would equate to the same sort of volatility. I mean, lots of like SQQQ. I mean, you can triple leverage short the NASDAQ because these companies that you state are so incredibly overvalued. Let's take a look at some of them. Home Depot here, guys. Home Depot's been on a wicked growth rate. Arguably, a recession could slow down the housing and construction, but the PE ratio has been hovering between 17 and 19, which typically is between a median since going back to 2015 for Home Depot. You take a look at a company like Goldman Sachs, which hasn't been posting the best numbers, and the PE ratio has fallen off a cliff from its historical averages, meaning maybe that's been priced in. You take a look at JP Morgan, which is still posting good revenue numbers, but putting loan loss provisions aside has been hindering their earnings per share. And that PE is probably on the upper end of value, but nothing like exuberated in my opinion. You look at something like Caterpillar here. This thing's trading at a PE of 18 and can hover anywhere from a 30 PE all the way down to a 10 PE, which seems to be a historical median for it. Again, you got a company here like American Express. This one's trading down back to its historical median. These are all sit on the Dow, guys. I mean, Apple stock, Microsoft also, I believe, sit on the Dow, and these are some of the upper valued ones, but these things have incredible earnings per share growth, incredible free cash flow, and arguably make better investment decisions than I think Tesla would in the current environment. Again, if you're looking to speculate and make that outsized returns, by all means, just somebody coming from my perspective, I just can't make sense of this. You take a look at something like Intel here, falling off a cliff. You take a look at something like Verizon here, trading at its lower end of its PE spectrum here. You take a look at, again, guys, Nike, which is also a really incredibly valued company, but the PE has pulled back a lot since the wicked days we've seen of 2020, 2021. Another company, McDonald's, is what I think he's looking at, like Pepsi, maybe Procter & Gamble, these consumer staples so many investors flooded into. These things, I think, are sitting at a much higher range of value for their current earnings per share growth than I'd be comfortable buying, but that wouldn't lead me to go take a short options bet, the Dow 30, for crying out loud. It just seems like such a wild swing of the imagination, and he doesn't really do a good job at breaking that down by any metric, in my humble opinion. I just find it so intriguing that not even an odd year ago, Jeremy was stating that small caps would be the first to bottom in a recessionary environment and also the first to rally back in a bull market. And I think there's an incredibly large amount of value at this point in smaller cap versus the stocks that he's currently buying, and he's just really like a squirrel chasing a nut, leveraging into the most volatile volatile large cap companies. Now, I could make sense of it if he had some value sense behind him, but his value sense is purely speculating on future expectations, which again, there's nothing wrong with doing that in your portfolio. I do it with small cap companies, and I'm even looking at purchasing other small cap companies. For me specifically, trying to build generational wealth has to come from a fundamental standpoint, a place of solidarity, a place of passively investing, whether that's into broad-based index funds or buying companies that you could put your finger on today, forgetting future speculation. You know their fair value today with companies like TSM, a PE of 15, incredible historical growth on the cash flow, pays a really good growing dividend with a really low payout ratio. And I think I'm going to get foundationally incredible returns from that without having to short the stock or chase shorting the market, because how do you sleep at night knowing your portfolio is going to continue to go through 50% mood swings? In a great bull market, it is incredibly advantageous, but in a bear market, you realize that you're just purely gambling on stuff that does not exist in the moment and is purely future based, which again, there's nothing wrong with it. It's just what's your comfort level with that? And I'm always blown away by Jeremy's comfort level. And I'd love to know what yours is and what you think about this in that comment section below.